Hello, this is Beast McFeast here with 10 more options terms that beginners should know. The first term we're going to look at today is the Black-Scholes model. You'll hear this thrown around as if it is a very accurate way to estimate options price, but it's not really that. You don't need to know it mathematically. Just know that it is a thing. It tries to describe how an option should be priced and how the price should change in relation to market events. This only really applies to European options, and it doesn't even describe those very well because people act in strange ways. It also doesn't work if you're discussing a put option or underlying with dividend and doesn't take into account fees. The biggest problem with this is that people don't always trade by the numbers, and because of that, the model is not 100% accurate. It has a hard time dealing with unexpected volatility in the markets, which a lot of option traders like to take advantage of. The next term we're going to discuss is the Greeks. These are 5 Greek letters used to describe how options behave in response to external changes. You can see they're related to the Black-Scholes model. Learning these can help you to avoid losses and profit in ways that you wouldn't typically be able to do. The most discussed Greeks are delta, vega, theta, and gamma. The last one is rho. It's rarely discussed, and in the past 6 months or so, it hasn't really come up at all because it's related to federal interest rates, which haven't changed. I've got another video up that explains the Greeks and how to use them in a very simple way. But for here, just know that the Greeks exist and they discuss options behavior. So intrinsic value is the value of an option if you were to exercise it, or if the person who holds the option were to exercise it. So an in-the-money option has intrinsic value. The extrinsic value is essentially the strike price minus the market price for an in-the-money option, and it's the absolute value of that. Now, the premium that you pay to get an option or to open an option position ensures that you can't just buy something with intrinsic value and immediately sell it, because that would be just infinite money for whoever buys an in-the-money option. But the premium is always greater than the intrinsic value on any option you buy. Now, extrinsic value is essentially the potential for value of an option. It's what you pay above the intrinsic value. So you can also think of it as, the option price minus the intrinsic value. You get that difference. Out of the money options only have extrinsic value because it wouldn't be worthwhile to exercise them. So all of the money you pay for an out of the money option is extrinsic to it. It's outside of what the contract is currently worth. If it is mostly determined by the price of the underlying, the time left on the contract, and the implied volatility of the underlying at that time, in this time frame we're looking at. So what is implied volatility? Well, let's look at real volatility. This is how much the underlying fluctuates in a given period of time. Now, it's not really useful for us to look retrospectively at the volatility of an underlying and say, okay, well, that's how volatile it was. What we want to look at is how volatile we expect it to be in the future. And yes, that is based off of what was done in the past, but we're buying contracts in the future. So we're looking at what the anticipated volatility of something is. If you're mathematically inclined, it's somewhat similar to an estimated standard deviation in the future. So open interest. When you're looking to buy or sell a contract, you'll often see an indicator on your screen that is labeled open interest. This essentially is how many of that one contract exist currently. It is a separate number for each strike at each date. You use this to help determine if there's enough interest in a contract that you'll be able to move in and out of it quickly when you're buying and selling options. So long and short. Long is essentially being on the buying side of things, and short is being on the selling side of things. If you go long on a options contract, whether it be calls or puts, you are buying that contract, which gives you the right to exercise it. With options, being long gives you the opportunity for greater potential profits, and it limits your risk to the premium you pay. So you pay up front, and that's how much you have on the table. And for like a call option, you could potentially gain infinite amount if you are only long. If you're short, you are taking premium in, you're getting a credit to your account, and this limits the maximum amount you're going to get to that premium and can expose you to unlimited losses unless you have some way to limit those, which is fairly easy. Don't be afraid to go short on things as long as you know what you're doing. So, spreads are combinations of long and short positions on the same underlying, and these can be used to reduce risk on short positions or reduce cost on long positions. They are going to cap your maximum gain on long positions, but they might also allow you to buy many more contracts to capture more of a small movement at a cheaper premium. So how does this work? Well, I set up an example here with SPY. So what we're seeing here on the right is SPY at a current price of $445.69. And this is a call debit spread, which is a long position. So what it is I've set it up so I'm long one call at the 449 strike with 17 days till expiration. Typically, this strike would cost $3.08 a share, or $308 because it's 100 shares in the contract. Now, notice I've capped it by going short on a call position. And I've shorted this call position at the 452 strike, also with 17 days till expiration. What that allows me to do is subtract the premium of the short strike from the premium of the long strike, bringing our cost down to $1.29, which is significantly better than $3.08. This might allow me to buy, just about 3 of these contracts for the same price I would pay to get into just one long call. This does limit my potential gain to the difference between the two strikes. So spreads can often let you play around in underlyings that would be prohibitively expensive for you to trade. Arbitrage describes an opportunity that traders like to take advantage of when it's available. It's really hard to find an opportunity that is a large arbitrage opportunity, but they do come up sometimes. It is when the same or similar thing are priced at different prices despite being roughly equivalent. And it allows you to take advantage of that price difference by taking different types of positions on them depending on which is the lower price and which is the higher price. So you might see this in the market if you have SPY and then the actual index, the S&P 500 index, were at prices that disagreed with each other. Now these opportunities don't come up in big ways. Oftentimes you're discussing a 1 or 2% difference in price, but if you are swinging around a large position on these and take the long and short of these appropriately, you can profit that entire 1 to 2% rapidly, which is very nice. An example you might get in your everyday life would be like buying toilet paper. You might pay about $1 a roll, or you might go ahead and buy 32 rolls for 69 cents a roll. It's the same thing, but because you're buying them in a different way, notice there's a price difference. And if you could buy a 32-pack roll at 69 cents each and sell them back to a market at $1 each, you definitely do that and you profit hugely. Obviously, it's not as easy to spot these in the market, as many of you have probably never seen a legitimate arbitrage opportunity, but they do come up. Thank you for watching. Please leave any questions or ticker recommendations in the comments. Good luck. Get rich. Bye.